Hi, my name's Trent Masters and I'm a portfolio manager covering technology for the Global Equity Fund here at Alphinity, and I just wanted to take you through what we saw during the month of August. It was another fascinating month in markets with a really aggressive sell-off to begin the month that was so violent it was triggering calls for an emergency Fed rate cut and even had the Intel CEO quoting God on Twitter. But by the end of the month, markets had stabilised and even managed to eke out some mild gains. So it is interesting how quickly narratives can flip in this current environment. Now, what August took in was the tail end of reporting season, and what we saw was a continuation of the patchy outcomes that we had seen during July. So in terms of sectors that had managed to outperform, if you had a look at what happens for earnings versus the expectations heading in, it was across the IT space. It was quite strong across both hardware and software, but financials also managed to beat market expectations. In terms of weakness versus those earnings cases, it was mainly around energy and materials, and also across consumer, which just feeds into the existing questions around how much pressure is the consumer currently under, particularly in those US markets, and that led to a real spread of outcomes when it came to the reporting of those consumer stocks over the month. Now, if we focus in on tech and start on big tech, we managed to get some answers to some questions that we had, but at the same time, we had even more questions emerge. So having a look first at Google, the main concern heading in was whether they had lost any share in search, but the search result for Google was actually quite strong. The weakness for Google came from a bit of weakness in the YouTube business where it didn't quite meet expectations, and also an antitrust case that is looking to break apart the primacy of Google when it does come to those search markets over time. When we have a look at Amazon, the main focus heading in was how was that momentum looking in terms of AWS? Now, AWS beat expectations, but what dragged the stock lower was that the margins in their North American business were quite a bit weaker than what the market was looking for, in part because they were building a range of satellites for their broadband Kuiper business. Then we had, at the end of the month, the all-important NVIDIA result. Now, NVIDIA managed to beat expectations again, but this time around it wasn't really a blow-the-doors-off event. And so we saw the shares come under pressure post the result because even though the result was better than the numbers that were in the market, it maybe didn't quite meet some of the more aggressive expectations, particularly on the buy side, that people had for this time around. But the biggest argument across tech, and it continues, is where are the returns when it comes to AI? Because the amount of spend that we are seeing in terms of AI infrastructure just continues to lift, and the numbers are really quite enormous. And given the scale of the spending, it is actually starting to have an impact in terms of returns as it flushes through the P&L and starts to squeeze a bit on margins. So this time around, CapEx expectations for the hyperscalers for this year went up again. They're now north of $210 billion for the year, or up 40% on last year. Now, in terms of the returns, the market is getting increasingly impatient in terms of wanting to see the revenues start to flow on the back of that spend. But in terms of where we're at, personally, I think this is just that natural evolution that you have when you have a significant technology platform shift. And we've seen it before with the internet era. It really did take around 3 years before you started to see some decent traction in terms of revenues and share prices from when that first platform shift emerged. And it really did take 5 years for it to really start to gather some material momentum. And so I have a look at where we are now, around 20 months after the explosion of generative AI. And personally, I do find it quite encouraging that we have Salesforce, we have ServiceNow, we have Microsoft, we have Adobe, we have Meta, all pushing out AI-enabled products, and I do believe that these products will progressively get better such that in 12 months' time, I do think that we will start to see some of that revenue inflection that the market is so impatient to want to see. But it's not just a revenue story. We are starting to see more and more companies articulating the efficiency gains they're getting from putting AI through their business. Whether that's Mercado Libre in supply chain, whether it's Walmart talking about its use in terms of cataloging, these specific use cases are now starting to get talked about. Of course, on the aggressive end, we have Klarna talking about taking 30% of their sales agents. But we are starting to see those use cases emerge, and I do think that those efficiencies in the end will dwarf the actual revenue from the end applications. And I do think in aggregate, from what I'm seeing so far, that the returns will more than generate the current investment spend that we are seeing. Now, in terms of August, what else we saw across the team is that giving the conflicting signals that we are seeing across a whole range of sectors, we're all offshore trying to just get a little bit more clarity around what the end environment is actually like. So I was in the US, Chris and Matisse were in the US, so was Jeff, while Ty was over in Europe. And as I speak, Jonas is on his way flying to Europe to get a little bit more clarity, particularly around that healthcare sector. And so when we catch up again next month to talk through September, we'll be able to articulate some of the conclusions that we've pulled together from all of these investment trips, along with any other overarching changes to the portfolio that we've pushed through on the back of those conclusions. But until then, I hope markets treat you kindly, and we'll talk again next month.